See you ready?
Yeah.
All right. Test 1, 2, 3.
Welcome to the
June meeting of the Real Assets Committee, Real Estate and Real Assets Committee. While it's somewhat conspicuous, can we go ahead and have the roll?
Yep, absolutely. Thank you, Mr. Jones. This meeting is being conducted as a virtual and in-person meeting, so I will do a roll call of the trustees to confirm attendance. Mr. Jones?
Here.
And everybody else is absent.
All right. Everybody else in transit? All right. Well, I want to be respectful of the time of staff, and what they put together through here. So let's go through, do you need to do the procedure? The perfunctory
Yeah, so
okay.
We don't have anybody participating under AB 2449.
Okay.
We can come back to the minutes
Since we don't have anybody to approve them just yet.
Yeah.
Okay. Do we have any public comment?
No public comment today.
All right. All right. Team Real Assets then. Jim, if you'd like to go ahead and Tara, I'd like to launch into it.
Sure. Well, good morning, Mr. Chair. Our presentation today is a performance overview of the real assets and real estate. I'm joined by my colleague Tara Elijah, she's going to cover the real assets portion of the presentation. I also wanted to point out we do have representatives from our two consultants in the room. James Maina from Stepstone covers real estate for LACERA, and Mark White from Alborn covers real assets. So are we gonna, okay, thank you. Let's go to slide 3. So starting off with some context for the investment area we're covering today. All of real assets sits in the real assets item shown on this graph, which is really real assets and inflation hedges, which is one of LACERA's 4 risk categories. Core real estate resides in that category. But we do have also investments in non-core real estate that's going to be covered today. And those sit in the growth category, which is on the right side of this graph. So looking at the real assets risk category, the main objectives we show on the bottom here are to diversify returns coming from the growth assets. This should help mitigate some of the downside risk we have from our growth asset exposure. The assets in real assets generally provide some return coming from yield. And then we also believe that these physical assets should generate a form of inflation hedging in our overall portfolio. So moving on to slide 4, we wanted to drill down a little bit more. These are the 4 basic categories of assets that we're covering today. We indicate how each of these components contribute to the 3 key risk category objectives we showed on the prior slide. And these components are real estate, infrastructure, natural resources and commodities, and then lastly, TIPS. So just to review this is a review of our overall asset allocation in these categories. This shows our current policy allocations for the assets covered today, as well as our actual allocation as of March 31st of this year. So non-core real estate has a 4% allocation or 4% policy allocation to the total fund, but our actual allocation is 1.4%. So we are underweight that category. Some of these target allocations have been modified in the new asset allocation taking effect this year, which we'll cover on the next slide. But on here, we also show in the real assets and inflation hedging category, our policy weight in total is 17%, and our actual allocation is 15.8, so just slightly underweight to that. And of that 17%, 6% it goes to core real estate, 5% goes to infrastructure, 3% is in natural resources and commodities, and then 3% in TIPS. So core real estate slightly below our policy target at 4.3, infrastructure is slightly above target at 5.5.
Quick question there, Jim. Just to connect it back to some prior conversations we've had, is the underweight in real estate relative to kind of our disposition pacing and the reallocation of capital towards the new?
Yes, so we've identified, some investments we've wanted to make in core. We've brought where we've shared with the board two of the recommendations that were approved last year. So we have two funds that were not fully at the target weight we intend to reach. What's been we'll get to the performance of real estate on a few slides, but there has been a decline in values pretty consistently each quarter. So, we're not trying to market time, but we do believe, given that the values are going down and we're selling assets, which is why we're at 4.3 instead of 6.
Right.
We've been maybe a little bit more deliberate in redeploying capital into core, maybe with some expectation that we'll see more of the end of the declines in values in sight. But we have slowly reallocated to these two funds, and we're identifying future additional funds that we intend to invest in as the assets get sold down.
Okay. Because if I recall correctly, we slightly reduced the real assets thing for the upcoming SAA, right?
Yes,
Those were percentage.
that's going to be covered on the next slide. So we can move on then to slide 6. So this does show, the changes to the policy targets that are occurring. This is a result of the new asset allocation policy that was approved by the board a few months ago. Non-core real estate there is a typo on here. The policy target was 4%, not 3%. And that is being reduced to 2%. Core real estate is being reduced, as you mentioned, from 6 to 5%. And then infrastructure is also being reduced from 5 to 4%. So these policy weight reductions are going to actually take place in 2 phases. This was part of the implementation plan that was also approved by the board in a prior month this year. It's going to take place over July, the first part of the implementation of the new policy target, and then the second will occur in January of 2025.
There's a follow-up question there, Jim, if you don't mind, is on the infrastructure too. If I understood some of the smaller conversations we've had with that, the part of the reduction was also a function, true or false, of as we've moved from more public assets to private assets in that category, that the deployment rate is likewise a little slower in doing that as well. So is that, or is that?
I think the reason why the infrastructure allocation was reduced it didn't really have to do with our public-private. It was more about I think where we are in the cycle for rates. Mm-hmm. And so, infrastructure, real estate, our other real assets, sits in kind of the middle of the barbell between growth and, our low risk assets. And, with the increase in interest rates, our public market bonds look much more attractive, maybe relative to private assets that have, maybe a similar risk return objective. And I think for the first time in quite some time, public market. So what we saw in the asset allocation study, which I don't want to speak for, but we did see basically a reduction in some of these assets like infrastructure and real estate, and then an increase in public market fixed income.
Okay.
So I think that's more what drove.
Yeah, I just wanted to sync up what I thought I recall some of the conversations were. Okay, thank you.
But we'll talk maybe a little bit more in a future slide about where we are in the implementation plan, going from public to private. But just to continue on here, we are there's I guess a couple of other components that are also going to be changed. We are changing some of the benchmarks for some of our asset categories, and this was also done and approved by the board as part of the implementation plan that was approved a couple of months ago. So in infrastructure, we're switching to an overall lagged benchmark, and this reflects that the majority of our assets are now in private structures rather than in public markets, and those assets are generally lagged by a quarter in our valuations. For natural resources and commodities, we're replacing the commodities component of the benchmark with the NCREIF farmland benchmark, We think this better reflects the private assets we have in place. We basically have a 1% allocation to agricultural assets that should be represented by this benchmark. And then the other side of it is, as part of the structure review for real assets, we've had a longstanding plan to eliminate commodities in the real asset structure, and that will happen in the coming months. And basically, again, as private portfolio assets have been invested, we have less of a need for public market real asset investments. So
Let me ask you to pause right here, Jim, real quick. Linda, could you duly note that trustee Fay and trustee Me are now here, so we do have a quorum?
At 8:11.
All right, thank you.
All right.
Go ahead.
So and maybe just to point out the other two benchmark changes that are shown here. So we are in the natural resource side, in addition to what I just mentioned about commodities and farmland. We are also lagging the natural resource benchmark. Again, it's reflecting the greater weight of private market assets in the portfolio relative to public markets, which has occurred recently. And then lastly, for TIPS, TIPS are Treasury inflation protected securities. As part of the implementation plan, the board did approve a change in the benchmark, and this is from the broad Bloomberg Barclays US TIPS index to the shorter duration version of the TIPS index called US TIPS 0 to 5 year index. And this was done to reduce nominal interest rate duration risk in the portfolio. So then we're going to dig in now to the core real estate portfolio. We'll dig into, there's 5 key components of the portfolio we're going to talk about today, starting with core real estate. So in this case, our objective is to get some exposure to, or that's similar to the Odyssey benchmark. And Odyssey is a universe of about 24 core US-focused, open-ended real estate funds. This universe is divided into a few main sector categories. We have industrial, multifamily, office, and retail. As well, there's some niche sectors that are invested in as well. Moving on to slide 9. Within our structure, we are invested in 2 of the funds that actually make up the Odyssey universe. We intend to add to those in the coming year. We have some other core and core plus funds that make up overall about 1/3 of our exposure in core real estate. We show that in the upper right-hand side. And then the rest, the majority of our assets are still in separate account portfolios. And in our separate accounts, this is where LACERA generally owns generally the entire asset of a real estate asset through title holding companies. And these portfolio of assets are overseen by investment managers. So we are in the process, as we've talked about in the structure reviews, of transitioning away from separate account assets to one where we will be investing in commingled fund vehicles. And so we're still on that process. We also show it here some of our exposures to our core portfolio.
Hey, Jim, real quick before you complete the previous slide, in that transition from the SMAs to the commingled funds, do you have a kind of a timeline? Because I think we've been kind of talking about this as a part of the structure review since Stepstone helped us with that. Is that separate and apart from, or is it concurrent with the disposition of some of the older assets we're trying to get rid of? Or is there a pacing to get to the commingled funds that's kind of distinct from some of the old assets we're still trying to?
Yeah, I mean, so those are really the 2 key components of our structural change. One is, we have to sell off assets in our separate accounts, and then the other one is to redeploy that capital into funds. And so when we set out, when we had this approved by the board in early 2022, we kind of viewed it as a 3 to 5 year process. So we're a little bit over 2 years into the process. Yep. We started seeing some meaningful declines in the real estate space later into 2022. I think that slowed down somewhat the pacing of our sales process, but we have still, we do still intend to sell assets, we think, over the next 2 to 3 years. And then, at the same time, continue to redeploy into new funds.
So that separate account assets measure that we see there, we're anticipating that moving down to 0, 25%.
I mean, the goal is to get to 0, but I think, we'll have to evaluate every asset as they come up, that there's really a market for it. We've been successful thus far in selling off quite a bit of the portfolio in recent years, but we still do have, about, as you can see, about 2/3 of our core still has to get sold.
Right, thank you, Jim.
While we're asking questions, so for this graphic on the bottom left, is this by NAV or is this by square footage? Is this by count in terms of what our portfolio looks like?
I think it's on unlevered exposures.
Okay,
So it's looking through the individual assets, but unlevered.
got it. Okay.
Is that right?
It is based on NAV.
Okay.
Oh, it's NAV. Okay.
Yes.
So it's levered.
Okay, I just wanted to make sure because I'm seeing industrial, I mean, I'm happy that we're in more industrial, but I'm also thinking, is that just because that's what is inflated in value as opposed to office, which we may have more of, but now is worth a lot less?
Yes.
And then when I see other real estate, what is that?
So for us, that could be like,
So,
yeah, we have a hotel asset, and then
and then some of the other niche sectors that would like fall into there, like self-storage and things like that.
that would be in our funds rather than in our separate accounts.
Wanted to make sure. Okay.
So just pointing out more on the on what we see in the lower left, the sector exposure. So we have been relatively overweight industrial. Industrial's been the best performing sector in recent years, and we have been underweight office, even going into the past 4 or 5 years when we started seeing more significant declines in office. Office has been the weakest sector exposure. And that's really helped our performance. We're going to see in the next slide that our performance is underperforming, but actually the sector exposure weights have been helpful to performance. We also have some non-US exposure on the bottom of the geography graph. We have about 8% of our core is in funds in developed Asia and Europe. And having some Asia exposure has actually helped us as well. The Odyssey benchmark is all US assets. And then we also just indicate the portfolio guidelines that we operate under for the core program in the lower right-hand side here. So then turning to the performance slide for core real estate, we show the most recent performance in the lower left-hand side. I guess maybe the first thing to point out is we have observed a pretty significant loss in just the benchmark itself, which was down 12.7% in the year. Over the 3 years, we had a big run-up during the early part of COVID, so the 3-year performance is actually positive at 4.1%. But this decline is actually one of the larger underperforming periods for the benchmark in its history. We've had some we've underperformed relative to that benchmark over these 2 time periods. And we attribute it to a few key factors. First, when we look at the upper right-hand table, where we break out the performance of core versus between our funds and our separate accounts, we have really seen the underperformance come from our separate account portfolio. Our core fund exposures have generally performed better than the benchmark. We see over these time periods, which are the 1 and 2 year periods. And I guess in looking at the performance of our separate account portfolio, within the industrial sector, having an overweight helped. But our assets have been somewhat, have had longer lease terms than maybe the benchmark has had. And we've seen significant increases in rents in industrial properties, but you can only realize those rents when these leases turn over. So the relatively longer lease exposures in our industrial portfolio has led to some slight underperformance in that sector. that should translate into higher returns as these leases get closer to maturity. I guess also we've seen in our residential portfolio, we have seen some sharper declines. We've had maybe a more overweight exposure to the Bay Area market in our separate account portfolio, and that's been one of the weaker markets in the US, so that's also impacted our performance. Another aspect is we do have more leverage than Odyssey in our core portfolio, and in a declining market like we've seen for the past 5 quarters or so, that detracts from performance. And then lastly, as we've been selling assets, since our structure review was approved in early 2022, we saw valuations start to decline in mid-2022. We have an appraisal process that reflects current valuations that are adjusted quarterly. But actual sales transactions have generally resulted in some realized losses because transactions have occurred at a lower value than our appraised values. We described the difficulty of selling at a time when there's a lag between appraisals and transactions in the 2022 structure review. And this has resulted in some additional losses as we've sold assets. This is likely to continue as long as we see declines in appraised values that are affecting returns negatively in Odyssey.
Hey, James, in the yin and the yang between the older stuff that's declining value and we're still trying to optimize the cents on the dollar that we can recover from those, how do you all perceive the necessary delay in that from our ability to participate in what may be the trend opportunities looking forward? Like, how are you all trying to, when is it better just to finally cut loose so that we can go ahead and position ourselves over the anticipated 5 or 10 year expectations without?
Right. So, I mean, I think, the reason why we're making this transition is we think it's a better structure for us to be in these funds that can turn themselves over maybe more in a better way than we can do in our separate account portfolios. And so, we do desire to change our exposure to these structures. We're not necessarily looking to have a fire sale in our assets. So I think we're trying to make this trade-off of just being timely about selling assets so that we can redeploy into the new structure. And that may result in some losses at times, but to do it in a way that, we can look at a 2 to 3 year horizon and continue to sell.
If you don't mind, I'll use the chairman's prerogative here. Stepstone, who was here from the Stepstone real estate side?
James?
So, I mean, how do you all, and this is really just a point of curiosity, like how do you determine, when to hold and when to fold them and then just go ahead and live to die another day? Like, so as we think about the pacing, I know you're in the room and advising us on this. I mean, should we be moving faster? Do we, like how are you thinking about it as you're looking at it at the larger level, knowing what our structure is, that pacing of, let's just go ahead, take the write down for what we need to do and focus on the future structure?
Got it.
And maybe I'll just, we're happy to have James here today.
Yeah.
Margaret McKnight is our key
noticed that,
person on
Yeah.
our disposition planning. Like, she was engaged specifically for that part of the process. I think James has participated in some of those, but he's really not the key person, but I think he can talk.
Yeah.
No, I appreciate that.
No, it's one where, even just broad strokes as far as the overall core market itself, where it has kind of reflecting the slower transaction volume over the last 2 years, that it's one where from a disposition process, it's unideal in terms of just what the market is. But as far as from transitioning over to the core assets, it's also on their end as well with a lot of the open-ended funds, given they also have existing portfolios. As far as even with each quarter, we're still kind of seeing some negative returns here and there. But it's one where for kind of getting that uplift, I think it's better to be getting that uplift on the broader, essentially more expansive core funds, which do have just larger portfolios, where you have to take less asset-specific risk and more just getting that broader uplift with the overall fund market as opposed to getting it through the direct asset holdings.
Yeah. Cheers. Thank you for that. Putting you on the spot there. Yeah.
No, happy to answer.
All right, so moving on to non-core real estate. Non-core is really the alpha seeking. These are the higher returning segment of the real estate portfolio. It sits in the growth category. We do use an Odyssey plus or Odyssey plus a premium as a benchmark. In our case, it's overall Odyssey plus 225 basis points. Our portfolio doesn't really resemble Odyssey in that almost half of our exposure, maybe we can move to the next slide, is outside the US, and Odyssey is really a US focused benchmark. We also, expect our non-core managers to be opportunistic and invest in sectors as the opportunities arise. So we have more latitude to invest across these sectors in non-core. So we show here some of our exposures that might be, when you look at this relative to Odyssey, we see some bigger differences than what we see in core, where we're really trying to maybe manage the risks relative to Odyssey to be tighter in the core side relative to what we see here in non-core. So then moving on to performance on the next slide.
Oh, did you have something?
Yeah,
sorry.
I have a question. So I know that we're using Odyssey and with the spread, is there really nothing better? Because I think your point is very valid, right? We're not looking at the same thing. So like looking at us comparing ourselves to something that makes almost no sense for us. Why is there nothing else that we can use instead?
I think we considered it as part of the benchmark review that occurred a couple of months ago. And I think what we're doing in non-core is consistent maybe with what we're doing in private equity, where we're using in private equity case, a public market equivalent plus a premium, as opposed to a more private equity universe as the benchmark. So I think
with private equity, we're looking at similar sectors and how they're performing compared to public. These are completely separate assets for different reasons. Like these are, I know I probably already asked this question, but that's my, as I look through these different returns, I'm like, our correlation with Odyssey is going to be all over the place.
Yeah. I think the idea is we do expect over the long term to outperform Odyssey. It wouldn't make sense to invest in non-core otherwise. But yeah, there's going to be more dispersion than what we're expecting in core.
Okay.
So then, focusing on performance for non-core, we show the recent performance in the lower left-hand side here. We have seen some relative underperformance as well in our portfolio over these time periods. We can compare it to what the structures we hold them in the upper right-hand side over short time periods. And generally, again, we've seen at least lower performance over the 1 year and 2 year periods in our separate account portfolio. There really aren't a lot of assets left in our non-core separate accounts. There's really only a handful of assets. It represents only 15% or so of the total value of non-core. And we had a memo last month that talked about some of the difficulties of some of the more leveraged assets we hold in our portfolio. And some of those were assets that are actually in this non-core separate account portfolio, where we're likely to, or we may be in a situation where the asset value is equal to our debt value. So, and then just maybe focusing on our fund exposure in non-core, some of the things we attribute to the lower performance are we have deployed capital in recent years. You can see the vintage years in the lower right-hand side. We're still subject to some of the J-curve effects, as well as some of the write-downs for assets that are still in redevelopment. We also have at least one, well, we have two, but one more meaningfully sized fund of one in the non-core fund size. We're the sole investor. That's also been subject to some of the valuation issues that I was mentioning in California or Bay Area residential real estate. So we've had more exposure just through that one vehicle that's hurt performance. But I think just maybe looking forward in non-core, I think even though we see weaker performance relative to some of these J-curve and write-downs that have occurred, we do think that it presents an attractive opportunity to put fresh capital in for investors that can deploy in the current weaker market.
Right.
So, we are underweight in the space. We do intend to continue to deploy capital. Our existing commitments will continue to draw capital from some of those funds, and we think those investors will be able to benefit by making fresh investments in the market today. So I think now Tara's going to focus on the real asset side of the portfolio. Sure.
Good morning, everyone. So I was looking at the quarterly report, performance report on the other board meeting, comparing the real estate performance in LACERA Fund and OPED. I saw that in OPED, our performance in real estate is really good. It's 10% positive. I'm thinking, what are the difference between the two funds that we invest result in this completely different performance?
So currently, with OPEB, it's mostly with a REIT, public market exposures. And so working to build out the private part of OPEB. And so in recent quarter, we've seen some strong outperformance in the public markets. And so that's going to be driving that larger return that you see in OPEB, because that's real estate investment trust.
So in OPEB, basically, we don't have the separate accounts like we do in LACERA. And separate accounts seems to be the most least perform.
Yeah, so the OPEB currently has REITs, which are public market real estate securities. And in the future, it's going to be making commitments to funds. But there's no separate account assets in OPEB. It's a newer program.
Got it. One more question. So I was thinking, aligning with Trustee Chair Zhong asking, I was thinking, as we transition away from separate accounts, I know this now is the market's not the best time, the valuation low for some office space like that. I'm thinking, is there any kind of measure we can do, or the pacing of the transition to mitigate the loss in the transition phase?
Yeah, I mean, I think we're just being very conscious of, I think we're interested in making the transition. I don't think it makes sense to do it at any cost. We're being very deliberate when we're looking at individual assets to make sure that, we are selling it at the right time. We think if there's a reason to sell it later in the process because of, say, lease terms that are due to mature, or leases on the underlying, within the underlying property, that it makes sense to wait until some of those turn over, or we see, lease renewals. We're taking all of that into account at a property by property basis when we're considering when to sell any assets.
Thank you.
Okay.
Thanks, Jim. Good morning, everyone. Moving into the infrastructure piece of the real assets and inflation hedges category. Its role is to diversify from public markets and with contracted regulated assets that provide steady income. It's also broken apart by risk category, and going up that risk spectrum can provide some higher return profiles. This shows the infrastructure portfolio broken out on the top into its different components. We see that public market portfolio makes up about half of the infrastructure category as we transition into that fully private portfolio. Earlier this year, in the real assets structure review, the guidelines in the bottom table were approved, and those cover private infrastructure. And so with the colored bar charts that you see, they show where we are with regard to those guidelines from a geography and a sector perspective.
May I ask a question here too?
Sure.
Yeah, go ahead, Chair.
So I'm looking at the demographic here. It's hard to tell. Is 43% the U.S. and the Canada market, or
Yes.
is it emerging market?
Yes. U.S. and Canada will be 43%, and then the emerging market, we don't have any exposure currently, so there is no no exposure to emerging markets right now. So we just have 43% to US and Canada, other developed 16.1, and then Europe at 40.9.
Is the reason why we're not looking into emerging markets for infrastructure?
It is part of the guidelines. We can do 0 to 20% there. As we continue to build out the private part of the portfolio, we could definitely increase that exposure to emerging markets.
And one more question about the US portion. 43% is a lot, and then I want to hear your inputs about the US infrastructure bill. It's also called IIJ Act. So the government approved about $1.2 trillion of funding, federal funding to go into infrastructure in the US. How do we see that as opportunities and risks?
Yeah, so I think, we've tried to be relatively balanced. I think in some ways, Europe has been earlier in infrastructure investing. They had a lot of structures for public-private partnerships prior to what, we saw in the US. In the US with the new legislation that's encouraging some investments, we're definitely seeing that, particularly, as it relates to the energy transition sector, whether it's renewable power or other elements of that. So there's definitely opportunity. We're trying to just, have in the core structure, just have exposure to the main developed economies that are investing in infrastructure, which is largely, US, Europe, and then Australia, and maybe to a lesser extent in Asia economy. So I think we're just trying to, have exposure to everything that's going on globally in, core and then non-core infrastructure.
Quick question for you, Jim. I know it's about 8:40, about 20 minutes left. How much left do you have in your proposal, just so we can kind of
Well, we're
right
going to
size
cover
it?
Infrastructure, natural resources, and then tips are the three. So we're
Okay, I just want to make sure we're
halfway through, but
Okay.
I think
Do you
the
have-
comments
do you
are
have
maybe
question?
another 5
I just
minutes.
wanted a quick comment on the US market. My opinions, I think this opportunity will be the BIL bill for sure. And then what I see the risk could be when you invest it, I would say expect the duration of project to be longer. The reason I'm saying that is because in the civil engineering and construction industry, there's a huge shortage in the engineering workforce. So that might cause a delay in projects. So expect the duration might be longer than normal. So that $1.2 trillion of budget from federal, we don't have additional number of engineers to work on those projects. That's it.
Thank you.
So shifting into the infrastructure performance, overall, the category has outperformed its benchmark in all the periods shown. Public infrastructure, when we break that out, has outperformed in all periods shown as well. We do see some underperformance in the quarter in the private portfolio, and it is benchmarked to a public benchmark. So as I mentioned earlier, with the strong performance in the public market equities, we see some underperformance there. Also, we'll be lagging the benchmark. This is the unlagged against the unlagged benchmark. The bottom table shows how we've done against peers, and as we're getting into upper quartiles as the portfolio is maturing. Shifting into the natural resources category within real assets and inflation hedges, it has a similar role to diversify from public equities and also provide that steady income as well as an inflation hedge. So here we break out the various components of the natural resources category. The public market portfolio, again, makes up about half of natural resources as we transition into more private mandates. As part of the strategic asset allocation, we will no longer be investing with public commodities, the allocation that you see there. So we'll work in the coming months to dispose of those commodity assets. Earlier this year, the structure review guidelines in the table at the bottom were approved, and it covers the private portion of natural resources. The color bar charts show where we are with respect to geography and sector with regard to those guidelines. And you can see there's a little more dispersion geographically with the natural resources portfolio.
And just real quick, I know we got to go fast, the geography here versus geography and infrastructure, I noticed that we're, like you said, we have a broader dispersion. If we can use some of the skills or the context that we have when it comes to doing natural resources, if there's projects that we could do in infrastructure that could also allow us to be more broadly invested, that could be a really good idea as well. Just want to point that out.
Yes, thank you. So moving into the natural resources performance, overall, natural resources has outperformed its benchmark, the category, in all periods shown. We've had strong outperformance of the benchmark in recent periods for both the public and private natural resources. We do have a legacy holding within natural resources that is a drag on our since inception performance. The bottom table shows how we've done against peers. We have done pretty well. In last year, we did have some J-curve effect as we committed to some new mining and energy funds. So moving into the last category within real assets and inflation hedges, the TIPS portfolio. It has a 3% allocation to the total fund. And it also is role is to provide that inflation hedge with stable income payments. As part of the strategic asset allocation, as Jim mentioned, we will be replacing that benchmark with a shorter term 0 to 5 year benchmark to reduce some duration risk.
Right.
So we'll see that implemented in the coming months. And it has performed about in line with the benchmark. And that's what we would expect for this, is like a passive mandate.
Okay.
And with that, I'm just going to go over quickly just the summary to summarize all the categories that we have discussed today. All of the 1 and 3 year performance for the different categories are shown on this slide. Just to recap, for real estate, the portfolio is in transition as we move from separate account structures to the fund structures, and some of those sales of our directly held assets have resulted in some underperformance versus the benchmark. For infrastructure and natural resources, both categories have outperformed their policy benchmark in all the periods that we've shown here, and TIPS has performed in line with its benchmark. So with that, thank you, and happy to take more questions.
Yeah, thank you very much. Great presentation. Appreciate that, Tara and Jim. I think just from a summary theme from the 4 years that I've been on here, is that just as an asset class, real estate's, had pretty meaningful underperformance in kind of a 10-year window prior to the new structural review. So there's I'm sure my anxiety is no different than your anxiety. It's just anxious for our performance in this class to be significantly better than the prior decade. So just a comment, but I think it's just an expression, but just ready to get moving, right? Like, whatever it is that we need to do. And hence the question about the pacing, right? Hey, the old stuff's the old stuff. It's kind of a sunk cost at some level, oversimplified. When do we really get to go deploy, take advantage of the opportunity or the context that's in front of us today? So, but I know it's not that simple.
Maybe I would just put out that, I think because we still are in this situation where there's a lag between valuation and transactions, I think it's still going to result in losses as we sell, at least during this period where the benchmark is still declining.
Yeah.
At some point that will reverse itself, and I think will be much less of a factor, but we might still see some losses going forward. We're trying to show the performance for separate accounts versus funds so that we can isolate kind of the legacy structure versus the new structures. So that's one of the ways we're trying to just, communicate what's happening in that program.
One other thing real quick, just as on slides 33 and 34.
We still got 15 minutes, so whatever level of detail we still want to get into.
Okay.
So just to make
Yeah,
sure
I was trying to go fast.
Yeah.
For slides 33 and 34, I think, and on a go-forward basis, as we have these newer type of investments and we're shifting our strategy, it'd be really helpful for there to be like one type of like A, B, C versus S minus, S plus, S versus numbers. It'd be really helpful to see all these things together as one thing, and then we can have like a composite score. So then we'd be really able to determine which of our managers, whether it's public or private, how they're performing on a relative basis compared to each other, and we can weight them and do a decision matrix, but at least that allows us to, because right now, as I was looking through this, I'm like, I don't know who's actually good or bad based on this thing as I see it.
If you want to take a beat, Jim, and maybe talk about.
Yeah, I mean, I think all of the ways that we score them with these 4 categories and then the fees, the fees is more of a quantitative measure. Performance is a quantitative measure. I'm sorry, performance is quantitative as well. So the other 3 are more qualitative. I think the dimensions are somewhat different. So we've tried to isolate the scoring, between these 3 segments. And we're doing this across the board for all of our public market managers, all our private, across all asset categories in a similar way.
I'm assuming even with qualitative, there's some type of rubric, and that rubric could be broken down into numbers so we could see. I'm more thinking as we're making determinations, my natural thing when I see something like this is, okay, well, we want to be with the 5s and the A's, right? But what's a 5, and what's an A, and what's that across the board? And then for us to say, how do we find more of those top quartile for what we want? And then we can go see like, okay, what were the attributes that we could find and look for in future managers that would give us that? And as I look through this stuff, I think it's great. Actually, I think it's very helpful to have it broken out, but without it being apples to apples. And if you guys have a way to make sure that there's like an overall score, that could be one thing, but that was just one thing I saw.
Thank you, Deputy CIO.
Yeah.
Jude? Yeah.
No, and I think later on, I think it would be helpful for staff to do a presentation on the scorecard as we developed this before a lot of the board members were present on the board. But one of the nuances, Trevor, is that we did want to keep in this is not to have the aggregate score, because when we're doing due diligence on a manager, there's different pillars, and we want the team, as we do diligence, to understand that. So you may have a manager that's excellent in performance, but as we go through their D&I and stuff, that they may not do well on ESG and those type of scorings. And so that's the point of the scorecard, is to keep in mind that, wow, you can have a manager that greats at one thing, they may not be good at another. And there's no thing that will exclude a manager if they're good in one part. It's just to keep us aware of how they do.
Exactly. I'm actually thinking like that as a decision matrix. So if we say we weight D&I 15% and we weight performance 45, we would still be able to have a composite score based on what we think is the most important. It allows us to be able to filter for and then find those best managers. Because right now, maybe there's, because it was before I was here, but if there's some kind of easy way to be like, oh yeah, everyone else on the staff knows, oh yeah, this is obviously good, this one's obviously bad. From this, I'm like, hey, great, just show me how to translate it. But otherwise, it could be very easy for us to. Okay.
Yeah. No, and I think if I'll work with the chair and take that as a takeaway, that we can put this on the agenda later for an educational session for the board.
Yeah, and I think and I appreciate Trustee Fay for bringing this up, is the, I think over the 3 or 4 years that I've been here, and this doesn't mean that you all intentionally omitted it, maybe I just didn't notice it during the point of the conversation, is that, we used to get the decks with the presentations of who was kind of finally selected, but then kind of after the selection process, I don't think we've really invested much time as a board in the kind of after performance monitoring. What level of culling or turnover do we do? How do we create, I think everyone knows here that once you get selected, the power of incumbency is pretty strong in terms of being dislodged. So, you would really have to be an E level performer or F level performer to probably get dislodged. But, is it really the C performers, right? Like, how well are we really judging the incumbent group relative to new opportunities through there? I think it would be helpful for us as a board to just know how you all are thinking about it. What type of data are we using to attempt to quantify a A-level performer versus someone who's just not bad enough to be fired, but they're still hanging around, at some level. So,
and with that rubric, managers would also know that that's how they're going to be judged by. So they're actually going to then try to outperform in those areas, and we can give them the place, because right now they don't know what they need to do to get better for us.
Yeah.
Then how they know.
Yeah, that's a good point. There is a lot of, after managers are hired, there is a lot of ongoing, engagement with the manager. We do send questionnaires annually on ESG, DEI, and we do collect that data, analyze it, and go over it with the manager, and it does impact, these scores. So, and then each quarter when this scorecard comes out, we do also evaluate the manager, what has happened in the quarter, what are the changes. So there is a lot of ongoing monitoring that does happen, that I think maybe is not seen, but kind of tried to be reflected here.
And I'll say I'm happy to help with that because I've done this many times for other things. So I'm not just throwing it out there just to be like, let's make it hard for no reason.
And this is included in the board performance book every quarter.
Yeah, and like I said, I don't think it was by omission. I just don't think we've had an opportunity where we've allowed you all to better inform us how you're doing that. And, ultimately, we get a notification when a manager kind of is ended. We typically don't say, oh, well, I wonder why, right? Like we just assume that, okay, well, they must have not have been performing. But again, I think it's more around that perhaps a median, or as my daughter's Gen Z's iteration says, that mid performer who's not quite bad enough to obviously go, but maybe isn't worthy enough to kind of keep hanging around, right? Like how are we as a team, how are you as a team, I should say, thinking about that, right? And is there anything that we need to, perhaps give to you all to further support your ability? Could be additional data sets, could be, I know you guys have done a great job in terms of your technology plan and acquiring data sets and being able to do more and more kind of analysis ourselves. But yeah, so I won't believe we're a dead horse. Any other questions? Yeah, Trustee.
If you don't mind to go back to the slides about tips. Yeah. Tips performance. I don't know a whole lot about tips. Maybe you can help me understand it better. So look it up. Is Treasury inflation protected security, and then the principal interest adjusts based on inflation, right? So based on that understanding, my common sense is that in the past couple of years, inflation is super high. Isn't that the category should give us the performance? Like,
Yes, but I think, what we've also seen is that as rates have gone up, the way that treasuries trade is, when rates go up, generally, the prices decline. So there's two impacts. One is the basis for the principal amount is increasing with inflation, but the sensitivity of the actual asset to just generally higher interest rates has actually detracted from performance. And that's the part we don't like about TIPS, having it in our inflation hedging, because it is very correlated with nominal treasuries. So that's the piece that's impacts performance, but works against us when rates have gone up, like we've seen in the past few years.
so does it really do the job that it intends to do for this asset class?
I think it's a partial effect. So it's partially it does, but there's also this interest rate sensitivity that's hurt performance. So the net effect is it's kind of gotten us there, but it's there's a lot of volatility that's made it more challenging to be a direct inflation hedge.
Thank you.
All right, any other questions? If not, we'll take, let's see. Oh, minutes, yes, let's get back, review back to the minutes. So minutes from the last meeting that we had, when you all reviewed those, did you see from December 13th? I'm not sure if you were here. And Nicole, were you here December? No, so that would have been me. Seeing no other changes from that it was the minutes were captured accurately, motion to approve the December 13 minutes. All right.
A third, I guess.
Yeah.
Mr. Fain? Aye. Ms. Me?
Aye.
Mr. Jones?
Aye.
Okay, the motion passes unanimously.
All right, great. Items for staff review. I think Jude took away something as it related to
Yeah,
the
so
manager
an
scorecard.
educational session on the scorecards.
Yep. And that would be across all
At the
asset
BOI.
classes. Yeah, that would be, across all asset classes. Items for future agendas, good of the order, when we start with Trustee Fay? No? Trustee Me? There being none, other than just an early preemption perhaps to what Jude was going to do anyways. I know we have a long sought after vacant senior leader of real estate. Like to welcome Terry aboard. I sent her a short message via LinkedIn once I saw it at that perspective. So welcome aboard. Look forward to your involvement in these meetings in the future. Didn't want to put you on the spot right away, but from that perspective, but welcome aboard. So glad to have you as a part of the team. And with that being said, let's adjourn until a sharp 9 o'clock start.